Hi everyone, it's Miguel from Financial Analyst Warrior, and today we're going to learn about the basic and diluted EPS. Now, the reason why it's important to know about these measures is these are the main measure of a firm's profitability. So this is the most commonly used tool to assess if the performance of the stock is good or not. So usually when a firm announces its earnings, investors, mainly common shareholders, will look at the EPS and the stock will usually react to these announcements because people have some expectations of the EPS, and it will react. It will go down or up or down depending on the announcement. Now, first of all, you have to distinguish between basic EPS and diluted EPS. Okay, so basic EPS is the net income that's available to the common shareholders divided by the number of shareholders. So basically, if you have a set amount of net income, it gets divided among shareholders like this. Now, for diluted EPS, it's the same company, therefore it has the same amount of net income. However, it gets divided into more shareholders. So each shareholder gets a smaller piece of the pie, which is not, obviously it's not good for the existing shareholders. That's why investors want to know about diluted EPS as well as basic EPS. Now, in terms of the type of securities that can be dilutive, there's mainly three types of securities. Okay, first of all, and you have an example here, a pretty typical question of diluted and basic EPS. And you have here, for example, options. Okay, so the three types of securities that will be dilutive is option, and these are employee stock option, not financial option that you can buy on the exchange. These are options that are given to key employees. The difference is these options will issue new shares from the company's treasury. Okay, so now you have convertible preferred, which also can be dilutive, and convertible bonds that can be converted into new shares. Now, if you first try to solve the problem that we have here in terms of the basic EPS, you will have to use the following formula: net income minus preferred dividends, all of that divided by weighted average number of common shares outstanding. So we have the net income. Usually it's going to be given in the question. So 1,750,000 minus the preferred dividends, and you have here 25,000 preferred stock, and each paying $10 dividend per year. Therefore, it's 250,000. The reason why you subtract the preferred dividend is preferreds, as you know, get paid before common shareholders. Therefore, you have to subtract this amount. And all of that is divided by the weighted average number of shares. Therefore, it's 400,000. Why? Well, because here you have 400,000 shares outstanding from January 1st until they issued some more in July 1st. So it's 400,000 times 6 months out of 12. Plus, then you have 200,000 extra shares in there. Now you have 600,000 shares times 6 months out of 12. So the weighted average number of shares is now 500,000 for the year. And if you do the math, you get a basic EPS of $3 per share.